Big news dropping before the weekend. The Treasury's monthly budget report just shocked everyone with a surprise surplus. Tariff and trade wars are heating up significantly. Jerome Powell might be resigning, and CBOT data is released showing some very large bets on US Treasuries. So here, some tariff just to run through some of the tariff updates. 35% tariff has been threatened on Canadian goods that are already not part of the USMCA. This is Canada is delaying their response, their retaliation, hoping for a trade deal. Apparently, those negotiations are in place or in effect are ongoing. 30% tariff on goods from EU and Mexico was just announced like an hour ago. This is set to go into effect August 1st. You already have Europe threatening countermeasures, counter tariffs. You have 50% copper tariff announced a couple days ago. We can see the reaction that copper had from before that announcement to the peak was about 17, 18%. Up until now is about 11.8% increase in copper. This is a massive input. It's very, very important to watch copper. People call it Dr. Copper for a reason. Brazil will retaliate with counter tariffs. The U.S. has recently stepped up their tariff regime against Brazil. Now, it's important to remember we run a trade surplus with Brazil, so that appears to be mainly political, which is never good to see. I'm all for balancing trade, but you got to do it the right way. You got to be smart. You got to be objective. Using tariffs as a weapon to bludgeon political enemies is not the right way to go about things. Before we get into this monthly Treasury report that's pretty surprising on a number of fronts here, it's important to remember the context. So tax revenue and GDP have grown at about the same rate going back to 1950. We can see tax revenue as a share of GDP bounces between 15 and 17% for the past 75 years. Government spending, on the other hand, has greatly outpaced GDP, as we can see doubling going back to 1950. And that is really what is driving this deficit. So here we have the unemployment rate, again, a good barometer for kind of the aggregate health of the US economy. I understand it's not perfect, but this correlation is hopefully very clear. We would run a deficit when there's high unemployment, economic downturn to stimulate our way out. And then as soon as unemployment came back down, we would, bring the deficit back. Well, that all changed in 2007, I would argue, where we can see that unemployment is actually lower than it was in 2007, from about 5% down to about 4%. But yet the deficit went from 1% of GDP, which is reasonable or manageable, I guess you could say, to now an utterly insane 6%. This has never been seen outside of a economic catastrophe or a world war. And we have been running this utterly insane 6, 7, 8% deficit for the past 5 years. Here is another way to kind of visualize the problem. Debt has, going back to 2007, debt has grown 300%. GDP and tax revenue, again, they grow at the same rate as this shows, have only grown about 100%. Now, interest is another major driver of this kind of fiscal crisis that I argue has already started. We can see the effect of this on inflation, right? And so therefore, the Fed had to raise rates. Well, when you're highly levered like the U.S., you blow out interest expenses, blows out your deficit. It just makes the situation worse, and it kind of becomes a self-perpetuating cycle. And so debt. Put another way, looking at this chart, debt, we are only getting about 33 cents of return for every new dollar of debt that we are going into. That is clearly not sustainable. So here's the monthly Treasury statement. We'll go through this. I think there's some notable news and developments in the fiscal. Here is, for the month of June, revenue for the government over here in light green. And then in darker kind of blue, you have costs or outlays for the government. And we can see that the difference between revenue and spending is actually $27 billion surplus. Now, as we will see, that is not We are not out of the woods yet. I'll put it this way. A couple of things I think we should note here. Individuals paid $236 billion in individual income tax. Corporations only paid $66 billion. This will remember those two numbers when we get about 10 minutes in here. I'm going to show a chart that'll blow your mind and make you wonder why this is the way it is, given the way the chart looks. But again, remember, the vast majority of government spending is coming from mandatory spending. This is why I was fading Doge very, very harshly from November onward, was because I took one look at the actual budget, the actual fiscal reality, noted that it's all mandatory spending, and you're not going to be able to cut these kind of red meat, low-hanging fruit sort of items, which should be cut, in my opinion, but they're such a minuscule amount of the total federal budget that you were never going to balance the budget, and I said as much. They only ended up cutting, about 150 billion, which, as we will see, is like 1.5% of total government spending. The vast majority of it is driven by Social Security, which is growing over 3 times faster than GDP since 1970. Interest expense, which again, very mandatory, although it's not counted in mandatory spending. Interest expense, only way you get rid of this is by the fiscal dominance playbook, which we have gone over the past couple videos. You cut the federal funds rate down to 0, go full-blown emerging market, issue all your debt and bills, have very high inflation, financial repression, negative real rates. That is one way to get this number down, but there are consequences, pretty big consequences. Asset prices rip, inflation rips. So watch the fiscal dominance video for more on that. But there is a way to get this net interest down. But again, the vast majority of it is defense spending, Social Security, Medicare, Medicaid, these sorts of things, which cannot be easily cut. Now, for the month of June, I don't know if this is a coincidence, but tariff revenue came in at $27 billion. Well, that just so happens to correspond to the surplus that we ran for the month of June. Now, you cannot take one month and make it out to a trend. You can take a couple months and annualize it out, but 1 month I think is pretty dangerous to try to annualize because there's so much fluctuation, as we will see in some of the later tables. This is the same exact concept, but for the full fiscal year of 25, which started in October of last year and goes through October of this year. Again, corporate income tax, corporations are going to pay $366 billion for fiscal year 25. Individuals will pay $2 trillion. The government will spend $5.3 trillion, mainly on Social Security, about $1.2 trillion, net interest, about $750 billion, Medicare, Medicaid, about $1.4 trillion. Customs duty, tariff revenue, is expected to be about $108 billion. Now, a note on this, people have been saying, kind of out of nowhere, I started hearing this by a number of people, tariffs haven't gone into effect yet. We don't know the effect of tariffs. They haven't gone into effect yet. Well, as we will see in some of the later tables, but even from the June data, tariff revenue is up like over 300%. So unless there's Schrodinger's tariffs, which are simultaneously not in effect but also in effect and bringing in revenue, I don't understand that argument. They are very much in effect. They might be lower than they were initially threatened to be, but they are very much in effect, as we will see. Again, this shows that for the fiscal year 2025 in entirety, from October of last year to October of this year, the government will run a $1.3 trillion deficit, mainly driven again by mandatory spending. Here shows the month-by-month breakdown of revenue and spending. And what I want to show two things. So April, generally, you run a surplus because that's tax month. We can see both April of this year and April of last year, we ran a very large surplus. Well, the problem is that for the month of June, not a problem, but the issue is that for the month of June, you don't really see a surplus being ran because it's not tax season. So here we can see that last year, the month of June, ran a $70 billion deficit. Well, this month we ran a $27 billion surplus. So what that means, and that's because both revenue and spending, they went, both of them, in the right direction. 466 in terms of revenue, up to 526. That's in the right direction. And spending from 537 down to 500. So both of those moved in the right direction. That's good news. Hopefully that continues. And we can see about $100 billion swing from June of last year till June of this year. Here we see the total receipts for fiscal year 2025 are projected to be 5.5 trillion. Budget estimates for next year are that taxes are going to go up. The total surplus deficit, I think this is the most important. Year to date, we're already $1.3 trillion deficit. The estimate for the full fiscal year, which ends in October, is $1.88 trillion. And in the comparable period to date, the deficit has increased, right? So 1.2 trillion was the comparable period for last year, and that is increased. The deficit is getting worse. And GDP has fallen from last year to this year. So the deficit as a share of GDP is going in the wrong direction. And for next year, the deficit is projected to be $1.6 trillion, which again is down from the deficit projected for fiscal year 25 of 1.8. So maybe it's starting to stabilize. Maybe it's going in the right direction. I'm not sure. Here is monthly receipts and outlays and then the resulting deficit. Again, $27 billion surplus is great, but look at how tiny this little bar is. I think this paints the picture that I was trying to illustrate, which is, a surplus is always good, but look at how big just, the February deficit alone is like a $300 billion deficit just in the month of February. So, put it in perspective, I think is important. Here's the cumulative spending, revenue, and then resulting deficit. And again, you can see that over time, the deficit gets worse. Generally speaking, on a cumulative basis. Well, for this year, it appears like it might have stabilized. Now, we've only had the past 4 months of this data showing that it looks like it's kind of starting to flatline. That would be a good sign. But, we really got to wait and see if they can really kind of stop the deficit growth. Because again, we established up here, the deficit grew from $1.2 trillion comparable period up until June of fiscal year 24, and up until June fiscal year 25, it grew to 1.3 trillion. So they really got to stabilize the deficit here. Here is revenue for the government by component. Now, they don't break out tariffs, but we will see a table that breaks out tariffs and show that. Again, individual income taxes is the vast majority. Look at, like, for example, corporate income tax, this orange slice relative to the blue slice. As we will see in a couple slides, that'll blow your mind. So here is monthly revenue for the government, again, broken down in just slightly different way, month by month. Tariff revenue goes into other, which is light yellow. And, you can see that light yellow portion of the bar, you can barely see it up until the past couple months. We will see exact figures in a second here. Here's total spending for the government. Again, the vast majority of government spending is in these mandatory programs that politically you just cannot touch because politically there would be such massive consequences to it. Net interest, again, you could go after that. Fiscal dominance, emerging market, financial repression, negative real rates. You can do that. You can target this blue slice, but there are some significant consequences to doing that, as we've outlined. So here are outlays for the U.S. government by contribution for fiscal year 24, fiscal year 25. Again, net interest, defense spending, income, security, health, Social Security, Medicare are the vast majority of government spending. Here, again, I think is really, really important to nail this point because we're going to see a chart in a second that will make it even more infuriating. Individual income tax for the month of June, they paid $236 billion for this month, for June. Corporations paid $68 billion. Now, for the current fiscal year to date, individuals have paid $2 trillion. Corporations have only paid $366 billion. Now, look at this. So individual income tax is up from this time last year. It has gone from 1.89 trillion to 2 trillion. Individuals are paying more. But look at corporate income tax. Corporate income tax has actually gone down. Last year at this point, they had paid 392 billion. This year at this point, they've only paid 366 billion. So the corporate income tax is going down, individual income tax is going up. This is, in my opinion, the complete wrong direction. You will see a chart that will illustrate why I believe that. Customs duties, again, this is tariff revenue. This month we took in 26 billion, the exact amount of the surplus. Current fiscal year to date, tariffs have only been in effect 2-3 months. We've already brought in $108 billion, comparable to at the same point last year, only 55 billion. Again, you got to really look month to month because of how these numbers are calculated. We'll look at that in a second. But the point here is that if you annualize out on the current path, and remember, tariff rates are only going higher, kind of generally speaking, not week to week or day to day, but month to month. If you zoom out, the tariff rates have been going up. So at the current kind of rate, we will take in about $300 billion in tariff revenue. Well, if you look at the bottom 75% of income earners, that's how much they pay in individual income tax. So again, remember, this administration promised you that they would raise tariff revenue and they would cut or eliminate the income tax for the vast majority of income earners. Due to the way tariffs are actually calculated, this makes sense for basically everyone, because remember, say a 50% tariff on an iPhone. Well, if the iPhone costs $1,000 here in America in your hand, that is not the 50% tariff does not go on that. It goes on the input, the import cost, the wholesale cost. So generally, Apple and most companies run about a 40-50% margin, something like that. So what that means is that 50% tariff theoretically is only getting applied to the $500 iPhone. I've done the math, and for the vast majority of people to spend, for the tariff revenue to increase, to be higher than the amount that they pay in income tax, they would have to buy a staggering amount of stuff. Like someone earning $40,000 a year would have to buy $60,000 a year of tariffed goods. Like, it just makes no sense. These, if you look at it, people would save money. The average kind of bottom 7 or 8 tenths of income earners, you would save substantial amount of money, unless you're literally spending 120% of your gross income on Temu stuff. Then maybe, yeah, you're paying more in tax, but in tariff tax. But in general, for most people, it would be a massive benefit for them. Maybe I could do a video showing that math. It's quite eye-opening. So I think it's important to keep pressure and keep reminding people, they promised you with all these wonderful tariff duties coming in, they would eliminate your income tax. So again, just a reminder, I think it's important to hold politicians accountable to what they promise. So these are every single spending program and department, and then revenues. But in table 7 down here is something that I think is interesting when talking about the tariffs. So here we go. Customs duties. So if you look at the customs duties, this is tariff revenue for last year, it was bouncing between $6 and $7 billion per year. Well, for this current year, for June, we took in $26 billion. We will see a complete breakdown, but where it shows a 300% increase from June of last year. But this puts it into perspective just how much tariffs are very much in effect. We went from $6.5 billion per month to $26.5 billion per month. This is a dramatic increase. Again, remember, individuals fiscal year to date have paid $2 trillion. Corporations have paid $366 billion. Remember those numbers. So here, corporate income tax, again, as we established in the other one, we can see that corporate income tax went down 17% compared to June of 2024. Meanwhile, individual income tax went up 16%. Customs duty here, we can see 301% increase for fiscal year 25 versus fiscal year 24, June to June. So from June of last year to June of this year, comparing June to June of this year, tariff revenue has increased 300%. That's a 4x in tariff revenue in terms of increase. Again, though, remember that these programs, the spending side, a lot of these government programs, the spending increase is dramatic. They are, the spending side is really what's growing faster than GDP. And, as we can see here, total budget receipts, so the revenue side of the government for fiscal year 24 to fiscal year 25, this has grown at about 13%, again, comparing June of 24 to June of 25. And budget outlays compared to June of 2024, budget outlays on a net basis have decreased significantly. And so, this is a step in the right direction, but to really get to a balanced budget or even a deficit, back to 2 or 3% of GDP, it's going to take a lot. So I mentioned the chart. So here is going back to the end of the gold standard, corporate profits relative to average hourly wage. And we can see corporate profits have increased 5,878%, while the average American, the average hourly wage has only increased one ninth that, 1/8 and a half at 821%. This is one scale, a percentage change for both of these metrics going back to 1971. Corporate profits have just soared. And this is mainly due to globalization and some of the trade policy, which is why I support tariffs and in general trying to target the current account deficit, that is one of the main reasons that is driving the white line higher and also consequently the red line lower. Because remember, they're outsourcing, offshoring all those high-paying jobs to much lower cost countries. And so here, I think it's just sometimes interesting to go back to like pre-2008 and see what some of the numbers were. Just like for perspective, I think it's interesting. Revenue and outlays, like the scale of the problem when you're talking about, we vacillated, but there were many months that we would run a surplus or basically no deficit. You're talking 10, 20, $30 billion. We're talking about like hundreds of billions of dollars per month in terms of the deficit now. So just in the past 20 years, sometimes I think it's important to zoom out and really kind of see the scale of how bad this problem has gotten over the past 20 years or so. Here is the news that Jerome Powell is apparently resigning. This came out of nowhere. Best I can tell, Pulte, who is the head of like federal housing department, he just created this. He just tweeted that I'm hearing Jerome Powell is going to resign. This is great. No one could find any source other than him just saying, I'm hearing Jerome Powell will resign. Then, I think it was like 10, 15 minutes later, he puts out this news release saying the same thing. I'm encouraged by reports that Jerome Powell is considering resigning. Like, he basically cited himself as the source for this. No one can really tell where the actual original rumor actually originated from. It best we can all tell, from what I've read, at least what I've gathered, he just created this rumor and then it kind of started to spread, and then he cited news organizations that picked up on his initial comments. He then cited those news organizations who were only just reporting on what he had just said prior. He then cited them as a source, wrote this letter. I think that the war on Powell is clear. This lines up with our entire thesis that we've been outlining in the past couple months, really. The war on Powell is clearly escalating. Whether or not Jerome Powell is actually going to resign is a different story. I think what they're trying to do is just ramp up the pressure on Jerome Powell. So here, let's take a look at the yield curve. There was some interesting CBOT data, Chicago Board of Trade, and this shows like positioning. Before I move to the positioning on Treasury bonds, Goolsbee also had some comments yesterday afternoon. The gist of it here is that tariffs and tariff escalation, right, raising tariff rates, risk inflation, and that he wants to see a few more months of good, PCE inflation prints before he considers cutting rates. So this is, again, indicating that kind of wait and see. At the same exact moment, you have Pulte, basically trying to like pressure Jerome Powell to resign, even though he was probably not planning on resign. So there's clearly this tension going on where the Fed officials are going, look, tariffs, especially if the rate is going up, are concerning to us. And we gotta wait and see how that plays out before we cut rates. You just have this ramping up of pressure from the administration. Now, CBOT data. So the 5-year Treasury bond. Now, remember, we had a good 10-year auction and a good 30-year auction this past week, but we had a not so great 3-year auction. Well, that's the belly of the curve. Let's look at the 5-year Treasury futures. They are net short by 39,785. Excuse me, increased by 39,700 contracts to now a net short of 2,516,000 contracts on a cumulative total basis. Remember, this 5-year here, we can kind of see a proxy for, or no, the 5 year is actually on here in green. What that is betting is that the 5-year will move higher. So again, the bias, in my opinion, appears to be towards rates moving higher. Speculators also increased their 10-year Treasury futures exposure by 56,000 contracts. So they went even more short on the 10-year, which we can see here in blue, this blue line. They went even more short on on the 10-year Treasury by 56,000 contracts. They now have a total exposure of short 840,000 contracts on the 10-year. That is the blue line. The 2-year are net short. They increased their net short there by 14,000. And so what we really see is the most change. The biggest change is on the 10-year Treasury, and the smallest change is on the 2-year Treasury, which we can see here in red. That is the red line. So they still ramped up their short bets, again, indicating the red line, the 2-year. They expect to go up. They still increased their short position on the 2-year, but not nearly as much as the belly of the curve in the 5-year, or especially the 10-year, which is in blue. So they are expecting the curve to steepen, is what this is indicating to me. And this lines up with what I've been saying for the past 9 months or so. I still believe the curve will steepen notably, even if you get, or especially if you get this kind of fiscal dominance, financial repression, negative real rate strategy that the federal, the Trump administration, the federal government appears to be pushing for, of cutting the federal funds rate, this white line, down to like 1, and then just issuing all of our debt at the short end. I think the curve will steepen. It appears that speculators are increasing their short bets, indicating that rates will go up across the curve. They are indicating rates will go up on the 2-year, the 10-year, and the 5-year. So the fact they increased that net short exposure, and the cumulative, the total kind of notional exposure is so high, the market is clearly betting on a steepening of the yield curve. So anyways, hopefully that was helpful. Ran through, I think, some of the big news. The fiscal situation is, in some ways, it appears to be getting slightly better. 1 month does not make a trend. We will have to really wait and see. But I think, again, going back to this chart that I was showing here, and some of the data that we were looking at in terms of individuals versus corporations, but also, with promises, right? They promised they would raise hundreds of billions in tariff revenue so they could eliminate the income tax. Some of these things, get into politics, which I try to kind of, not dive into too much. But some of these things are I think really important. I think this chart is just insane. Like, I don't know how anyone from any party could look at this and think that this is okay, and then look at the fiscal data and see that individuals are paying more money, but but corporations are paying less. Like, you take this chart and you think that the white line should go even higher and the red line should go, right? Like, the gap should get wider. I don't know. I would venture to guess 90 something percent of average Americans watching this video would think that that is crazy, given this chart. So some of these things, I think it's important to make people aware of, so that we can pressure our so-called leaders, our politicians, to act in our best interest. So anyways, hopefully that was helpful, and I will catch you in the next one.